equity markets have opened higher, with the S&P and the NASDAQ coming off their fourth straight winning session to add to their strong week-to-date performances. So do quality and momentum just continue to work in today's business cycle? And how is our next guest factoring in next week's Federal Reserve rate decision into his overall outlook? Happy to say joining us here today for an in-depth conversation on factor investing trends and themes to watch is Fidelity Head of Quantitative Index Solutions, Bobby Barnes. Hi, Bobby. Great to see you again. How are you?
Hi, doing well. Good to be here.
Delighted to have you here. And we'll invite everyone to go ahead and send questions in over the next 30 minutes or so for Bobby to answer. Let's begin. We're going to dig into the factor story, but I mean, we just have to ask you where this economy is going, the business cycle, and let's start with the 25 versus 50 basis point cut that seems to be on the table for next week. What are your thoughts there?
Well, the way I think about it, and it's been, highly debated here, the prediction markets are all over the place, but, I kind of put myself in the shoes of the Fed and think about the job and what they're aiming to do. So, we all know about the dual mandate, stable prices, full employment. But that being said, it's a very slow feedback mechanism, right? You adjust your rate in either direction today, and you really don't see the impacts of that for a very long time. And so given that, I think that it makes the most sense to, when you can, to go slow and steady in either direction, right? And that's kind of what we saw on the way up, right? Part of it was a little bit of debate of whether or not inflation was transitory, but either way, it was still, given the nature of the system, it made sense to at least start slowly. And only when it's forcing your hand do you react more quickly with larger changes to Fed policy. And so that's where I think, in thinking about the cutting cycle ahead of us, unless there's, something that's, the roof is on fire, yep, then you take it slow and, do 25, maybe even pause afterwards just to kind of see how things are going and run your policy that way. So I would be in the camp of 25 next week.
Especially after a week like, everything just seems fine. It's been such a wild stock market. Let's go there ultimately, because momentum, quality, I mean, there's a case for vol here, certainly, since probably mid-August, early August. Tell us a little bit about the markets that we're in. Are we in the end of the business cycle, which, is notoriously pretty volatile? Tell us a bit about the business cycle you see right now.
So with respect to the business cycle, I would say that we're still, solidly in late cycle from what I can tell. So there's no recession indicator that is in terms of right now that I'm seeing. Unemployment is still at multi-decade lows, which is, constructive. The growth, companies are growing, they are experiencing earnings growth, slowing growth, but still, positive, not necessarily contracting. And so you put all that together, solidly as it stands right now, late cycle, which is what we've been in for what feels like the better part of 2 years now. The playbook from a fact perspective is usually quality and momentum, which you hinted at. Although we did kind of get into some interesting ups and downs over the course of this summer. So, when June ended, we went into July, you saw quite a fierce rotation out of the momentum names and into actually small caps was the dominant factor over that 1 month of July.
July small caps. That was the story, wasn't it? Yeah. What was that about? I mean, okay, it was a rotation. We were all kind of expecting certain types of rotation. Is that all it was?
Well, I think it was more about positioning. And not many people are talking about that, but a lot of investment managers have a policy portfolio where, let's take 60-40, right? Plain vanilla, equities, bonds, 60-40. And, every quarter, you rebalance back to your policy portfolio. And so what that means is if equities outperforms bonds and you get to the quarter end of June, like we did, then you would, sell down some of your equities and buy some of the bonds. And so I actually think with respect to small caps, that's probably what explained the rally that we saw in July, where I think at that point, small caps were trailing the S&P 500 like over 1,000 bips, if not more. And so it's like, okay, well, if you have a policy portfolio, you probably need to adjust back to whatever those parameters are.
Like
And I think
whatever did the worst last quarter type thing, we go in
yeah,
by.
yeah. And I think ultimately that's why that rotation wasn't sustainable, because to be sustainable, it needs to be more fundamental driven. Like, the economic prospects of smaller companies are improving, and hence, you can, chase that rally. And that's, not what we saw until in August. A lot of that outperformance was given back. And same has been true month to date for September.
Right. Interesting. So it could happen again. Just to go back to the small cap story, I mean, unless I'm missing something with the business cycle, you sort of need the downturn sustainably before small caps catch. I mean, is that the fundamental story is missing? I guess is what I'm asking.
Yeah. So the tricky thing about small caps is they're more economically sensitive. And so they typically do well when economic prospects are accelerating. And so the narrative that I shared at the top, which was that we're in an environment where there's growth, there is economic growth, but it's slowing growth. That's actually not constructive for small caps. That's where the higher quality companies with the better balance sheets, they typically do the best in that type of environment. And so if you ask me the question, okay, well, when should I buy the small caps then? You typically need to go through the whole cycle. So you actually get to the point where you have economic contraction, small caps underperform and get very cheap during that part of the business cycle. And then in the recovery is when you get the snapback and really, really strong, sustainable performance from small caps.
So, I mean, if that was a positioning situation, could that not happen again now? I mean, what we've seen we've seen a lot of buying of the dip, really. I mean, when things have gone sort of brutally for some of the Mag 7 over the course of the last month or so, buyers have come back in the next week to scoop them up. Tell us a bit about that and what it all means actually for the Mag 7. I mean, what sort of strength do you see going forward for them versus the rest of the market? And then we'll get
So the commentary over the past few months with respect to the Mag 7 has been very interesting. You saw a lot of weakness in the Mag 7 in July and then August. And what I found interesting is I talked to investors about the Mag 7. If you ask them, well, why are you skittish about it? Why are you trimming some of your bet there? And usually got answers to the effect of, well, they're up so much that I feel like I should sell some, which is not a fundamental story. And and if you actually look at the fundamentals, because that's the other thing that's happened since you and I last got together, we just had a reporting season that just concluded, and the reported earnings for the Mag 7 were actually really good. The estimate revisions,
but they got punished anyway.
They got punished anyway, but it was not for fundamental reasons. And I think that's why you see investors coming back in, and to your point, buying the dip now, where they're kind of coming back around and taking that more critical look and saying, well, actually these companies are still printing money. The estimates are still rising. Actually, I want to buy and be in these names.
That's fascinating. So just back to sort of the positioning story that maybe could happen again. I mean, is it? It's not a mistake. It's a positioning story. But how do you get ready for that? There's got to be a strategy for that.
So it depends on how tactical you are. This positioning phenomena, you actually see it a lot, especially around the year end. And there are some investors that actually will, trade on a short-term basis to kind of capture those opportunities. I, however, usually take a 12 to 18-month outlook for, what I think investors should do. Mostly a function of just Fidelity being as big as we are. Most of the PMs I've worked with throughout my career are managing sums that are too large to say, hey, buy this for a quarter and then swing the whole portfolio another way at the quarter end.
That's what tractors are for.
Right. But yeah, and so I always allow for there to be what I call a counter trend rally, where things like positioning, for example, will cause whatever's been beaten down to work for a very short period of time, and then you go back to whatever was the prevailing trend before that.
That's fascinating. Okay, absolutely. I mean, this is the whole sort of quant story in a way. This is how it works. So tell us a little bit about what should be in what we think is a rate cutting cycle that we're about to enter. I mean, Canada, it's almost an old story here. We've been doing it for a while, but the idea of what catches a tailwind, it's the typical sort of defensive stories. There's also just this rotation that sometimes fits squarely with what we're talking about economically, and sometimes the Mag 7 just beat to their own tune, has nothing to do with the interest rate cycle at all. But with holding both of those to sort of be happening at the same time, what do you want to look at in a rate cutting cycle?
Well, again, my compass is always focused on the earnings and where things, particularly the revisions, and where things are getting better. And with the rate cutting cycle, it's funny, there's been a lot of talk about rotation throughout this year, but the rotation that people are talking about is not the one that I'm actually seeing. I'm seeing a bit of a rotation, but it's actually into some of the what I call bond proxy stocks, as opposed to the economically sensitive stocks or cyclical stocks like small caps. And so what you've seen year to date, as example, is you did get a broadening out where last year there were only two sectors that worked last year. It was comm services and tech. And so year to date, as it stands today, the best performing sector is actually utilities, which I don't think was on many people's bingo card. But yeah, that's it is what it is. And proxy sectors like staples and utilities, and then from a factor perspective, high dividend. Those are areas where they'll have a tailwind in a rate cutting cycle. But that being said, I'm still going to look at what's happening to revisions to really have the conviction on how those areas are likely to perform over the next 12 months.
Say a bit more about that. Okay, so you keep a close eye on revisions. I mean, I can see why you would, but just take us there a bit more.
Yeah. So keep an eye on revisions. As I mentioned, we are solidly in late cycle. But one of the things that is a little bit concerning to me is in our models that we have that predict so we're in late now, but what cycle are we likely to be in over the next 6 to 12 months? It actually is a case that I see potential for recession to be somewhere on that horizon, somewhere on that window. And so what happens is things start to unwind fairly quickly as you approach recession. And so that's particularly why the first place you're going to see that evidence of unwinding is in the estimate revisions for whether it be individual stocks, sectors, factors. That's going to be the canary, if you will.
Okay, really interesting because so what about, for instance, the inverted, uninverted yield curve? I mean, that seems to have a very long time span. So I guess it's not one of the great signals, but that also has been a really interesting story to watch.
Mm-hmm.
Do you watch it as well?
I do. Yeah, that's actually one of the many things that I look at. It's a part of that model that I was just speaking to that helps predict, what cycle are we likely to be in the future? And the inconvenient truth about the inverted yield curve is when you look at the historical examples of when it uninverted. Most of those examples, actually, I think almost all of them, were late cycle periods where over the next 12 months, at some point over the next 12 months, you were in recession. Like you transition out of late and into recession. And so that's the kind of the inconvenient fact that you have with with the yield curve uninverting now. If you just do that simple analysis and say, okay, well, what periods are most similar to that? That's the place that it gets you. It's a similar issue with unemployment, where it bottomed a year and a half ago, and it's been slowly ticking up. Not cataclysmic, but still up nevertheless. And it's the same conclusion that you'll come to, where if you look at periods that had a similar slow rise in unemployment, it looks very much like late cycle and then the precursor to a recession at some point. As you move 12 months forward.
Right. Okay. So we just come back to the buy, the dip, and the fundamental stories with sort of the backdrop of, it sounds like, the inconvenient truth is there could well be a recession, according to what you're saying, in the backdrop. So do you buy the dip for some of these big companies?
So I say you do, and for two reasons. And first, I want to assuage the audience's concern that there may be a recession. The one thing I should share is that in those most similar periods historically, the return of the market is actually positive. Now it's low single digits, but still positive nevertheless. And so you don't need to be fearful and go to cash. But statistically speaking, the returns are slightly lower, but still positive. So that's one reason why you buy the dip. The second reason gets back to the earnings story that I was highlighting, where the economic prospects for especially the larger caps, the Max 7 that we all have been tracking, they continue to accelerate. And so on balance, for your equity allocation in your portfolio, you still want to, when you're given these opportunities to buy them when they're on sale, that's a good time to buy them. So you buy the dip.
Really, really interesting. Let's come back to some of the unemployment story. It goes into the rate cutting cycle that we think we're going into in the United States. Ultimately, where could things get interesting here? Well, maybe they've already started to get interesting, which is why the rate cut is being considered. But where is sort of the rubber meeting the road here for what you're watching?
Yeah, so where it gets interesting, and there's some audience members might have heard the commentary about the SOM rule. And so I'll just kind of explain quickly what that is. So the unemployment rate, which I referenced,
this is Claudia Somm, right?
Yeah, Claudia Somm, exactly. And what she did was very simple. She observed that it's almost like inertia. So I'm a physicist.
You're a rocket scientist. Come on.
A rocket scientist, yeah. So she observed that when the unemployment rate is rising, it has a tendency it has this inertia to keep rising. And so the question that she answered was, at what point, like the percentage delta is very highly correlated with recession. And so what she found was that when unemployment rises by 0.5%, odds are, statistically speaking, you're going to go into recession, and that's what she's seen in the historical data. What's been a big source of debate with that rule is, a lot of market participants are saying, well, yeah, the U.S. unemployment it's actually crossed that trigger, but when I decompose where those increases in unemployment are coming from, it's coming from temporary layoffs as opposed to permanent layoffs. Intellectually, I think that's a valid argument. That's a valid retort to her rule. The inconvenient truth, however, is there's another economist whose last name is Joshi, and so he took her rule and refined it further and said, well, yeah, it makes intuitive sense that you should only pay attention to permanent layoffs, not temporary ones. So let's redo the whole analysis and find what the delta in the permanent layoffs should be to calibrate. Okay, are we likely to go into recession over the next 12 months? And so what he found was that if you're focused only on the full-time layoffs, the increase in that is 0.2%,
rather than 0.5%.
Rather than 0.5%. And oh, by the way, we've actually triggered that rule too. And
okay.
So that's one of the many things that it's on my radar that's saying, okay, this is to be fair, these things are correlated, but this is not causation. So it's not like you're going to be in a recession because you've triggered this rule. It's just saying, it's highly correlated with past occurrences of recessions.
Okay, fantastic. So, I mean, that fits into a fundamental story ultimately because it's the economic backdrop. But there is a question on talking about, yeah, okay. So the question is, what are strong fundamentals for earnings growth?
Well, what I'm seeing with respect to earnings growth, so the large caps have been doing great. They actually have been experiencing, at the aggregate level, have been experiencing rising earnings revisions year to date, which was actually fairly rare. I mean, normally market participants are overly optimistic about the economic prospects of the S&P 500. And so the natural tendency throughout the year is actually to see revisions down at the aggregate level. So having them go up year to date is actually very constructive. Where it gets interesting, however, is when you take a peek underneath the hood, all of that upward revisions that we've seen year to date has come from the largest stocks. And so if you exclude, say, the 10 largest stocks of the S&P 500 and rerun that calculation, the revisions are actually down, not in a cataclysmic way, but more aligned with what you experience on average. But then as you go down in market cap to say, let's run this in mid caps and we'll run this in small caps, they're actually deteriorating pretty quickly. And so I think those are early indicators that it could spread to the market more broadly, and then you would see similar deteriorations in the large cap stocks as well.
So, okay. And part of that you pin on the fact that the cost of capital is high and it's harder for a smaller company to deal with that. Is that
That's right. Yeah, exactly. The cost of capital is high. Small caps have more floating rate debt. They have more debt, and a lot of that is floating rate, which means they're paying higher costs on that right now. Some people actually say that that's the proponents for small caps right now say that the rate cutting cycle would ease that burden for small caps, which if you held everything else static, that would be true. But where I have a different view is that they're going to reduce rates because the economy is slowing. And so, yes, you reduce the cost of debt burden, but if that's happening at the same time that fewer people are working, which are customers to those businesses, that's not a fertile background to be placing bets on small caps.
So just to dig a bit further into that, where do you go a few months out? So because also the cuts along with hikes take a little while to sort of be felt, essentially. So if we can look through a little bit here, what do you see? I don't know, you pick the timeline, but if you look through sort of this initial rate cutting, this new cycle that we're about to enter here, what do you see a few months further down the road?
Sure, yeah. So going back to the Fed cuts and them operating with a long and variable lag, in my work, it usually takes, the policy decision in any direction usually takes about 15 months to have its intended effect. And so if you get at least in the US, if you get your first cut next week, then, you're about, let's just call it the nice round 18 months out. So a year and a half from, next week that you'll see that stimulative effect. And so for long-term shareholders that are willing to look through what could be a downturn in a cycle, that's kind of what your horizon would need to be to make that assessment.
Really interesting. Okay. So what will we be coming back to in terms of factors ultimately? I mean, momentum can work in both directions, of course. So are we sticking with sort of the ones that won't do too badly in a recession and that takes you to quality?
Yes, so quality is my number one choice, for the reasons that we've oftentimes talked about. It's in a slowing growth environment. It's the higher quality companies that have the strong balance sheets. Their earnings don't deteriorate as quickly or at all in some instances. And so in late and or recession, it's likely to do well. Momentum is also still high up on my list. It is a little bit higher beta than the market, but it's giving you exposure to those secular growth themes. And I know we've talked about it, the market getting skittish about the Mag 7, but again, if you keep your compass focused on the earnings, it's still the case that that's where most of the earnings realized earnings growth is right now, and so stay along that. Where I'm starting to, at the margin, get more constructive is on dividends. So I mentioned the bond proxy areas of the market potentially doing well. And I also like high dividends because it's a good diversifier to the quality and the momentum that I mentioned. If you form a portfolio with some form of valuation as expressed through a dividend, I think that could make for a good risk-adjusted return over time. And then the last one is just low vol, and that's your insurance. So,
That's your insurance. That's what I was going to say. That's
yeah,
to get you through these bumpy bits here. Yeah.
exactly. Yeah.
Fascinating. Okay, there's a couple of questions coming in. So one of them is, do you believe that the market will be or is driven by the U.S. election?
Good question. I had a client ask me that just yesterday, as a matter of fact. So yes and no. I think that if you're very tactical, there will be opportunities to if make a forecast about who will win the election, and then to buy those stocks that are expected to receive a tailwind, whether it's I don't know if it's solar or healthcare stock, et cetera. But again, going back to just my orientation about how I prescribe how people should think about the market and how they should invest. As I mentioned, I tend to take a longer term view, 12 to 18 months. And so I try to calibrate my mind around, okay, what prescriptions will be agnostic to whoever is in the office. And so a lot of the things that I'm looking at, for example, is I think the consumer is in a tough position. They, especially at the lower end, prices are still high. And you're seeing increased delinquencies, and so that's a trend that I think will likely be persistent, regardless of which administration is in office in November. And so, I let that kind of inform, okay, what prescriptions from a factor perspective, or if you want to take it to the industry or stock level, one should be positioned in.
So, okay, just say a little bit more, like which factor would you stick with? I mean,
yeah, so for me, it gets
a lot of stories around, unrealized capital gains and all that. So, I mean, that is tricky for some of the Mag 7. I don't know, but anyway.
Yeah, so from a fact perspective, because I'm going to focus on the prevailing trend,
okay,
and that still puts me back in the same place, with quality being my favorite and the rest of the narrative that I just walked you through. But that being said, for those who are tactical, like you mentioned taxes, hypothetically speaking, if you got into the November election and there was some massive tax cut, then you will see what the counter trend rally that I talked about, where over the course of a month or two, you could get the most economically sensitive stocks to outperform, like small caps, for example. But then after that, if you get beyond that, I think the market resets to, okay, but what are the earnings? Where's earnings growth? And that's going to be, unless you get some material change in economic conditions, that's kind of, back to quality, back to momentum, back to the secular trends, that kind of thing.
It is fascinating to speak with you and hear about the way you're looking at the market, because it can be quite different from what we hear from others. Is there just sort of a final fine tuning that you would leave with investors about, where we're going from here?
Well, I think it's going to be an exciting 12 months. So this is really gets my juices flowing. And, I try to assuage any concerns about a recession. But if we do get one, it ends up actually being one of the best times to be an investor. So I'm actually excited about what the next 12 months will do. And I'm sure when we reconvene, there will be some point where I'll say, Pamela, we're here, and it's time to, rejigger the portfolio in this way.
Fascinating. I mean, asset allocators and they're all asset managers. They're always excited about recessions because you just go shopping. Fantastic, Bobby Barnes. Thank you for joining us. Delighted to see you, and we wish you a good fall. We'll catch up with you soon.
Thanks for having me.